Hi, Gordon.
Hi, thanks for doing this interview today. I'd like to start with asking, sort of, in your experience, have you ever seen anything quite like 2020 in all your years of managing money in the city?
No, we haven't. And in terms of causation, clearly it's something very different from most of our experiences. In terms of the market's reaction, though, we did have something very similar in 73, 74, in terms of a major market correction, but that was spread over 2 years. And the causation clearly was very different. It was the increase in oil prices and the disruption of the miners' disputes. Now, so this is very different, and the timing scale is completely different, because we had an absolutely dreadful month in March and April, and then the last 6 months the recovery has been equally surprising.
And what would you say would be the lessons of 2020?
Well, remember that at the start of this year we were already experiencing a slowdown in global economic growth over the previous 2 years. The economic cycle had turned some time ago, and 2020 was looking as if it was going to be the weakest year of the economic cycle. And indeed, because of that, the recession risk obviously was much higher than it had been in previous years. So that momentum clearly gathered speed when we had this pandemic experience. And so the degree to which the economy went into recession in that second quarter is pretty unprecedented. And so it required a major policy response, which is what we've had. And the markets have responded to that likewise. And now we're getting news about potential vaccines. People can feel somewhat more comforted that the worst is probably behind them.
So what does all that mean for 2021?
Well, in a normal cycle, we would be expecting a degree of pickup in economic activity next year as the cycle turns. There are 3 factors that make me believe that that pickup is actually going to be quite a strong one. The first is that we have both money and fiscal policy pointing in the same direction. Both are supportive. That's very different to what we had after the financial crisis in 2008, where money policy was supportive, but we then had fiscal austerity for several years. Yeah. This is very different. All kinds of policies, monetary and fiscal, are supportive. Secondly, corporate profitability looks as if it's going to really bounce back quite strongly next year. This year, clearly, the corporate sector has taken a big hit, but that recovery is clearly allowing their profit margins to be rebuilt. And the third thing that makes us feel more positive about the economic outlook is that we've built up savings worldwide this year. People haven't been able to spend as they would have done normally. So there's a supply of savings which is looking for a means of escape, if you like, into higher spending. So all those factors, I think, mean that we will have quite a strong start to the year, and the momentum will be positive as opposed to the negative momentum we started this year with.
And so in terms of corporate earnings and profitability, I mean, does that go hand in hand with a restoration of dividends and back to the dividend culture that you're used to in the UK?
Well, I'm sure we'll get an increase in payout ratios, yes, and many companies have already indicated they're going a particular line. But whether we go back to the same level of payout ratios that we had 2 years ago before this started is more questionable. Because one of the things I think has come through this, one of the big lessons, is that companies need to be resilient. It's no surprise that it's the companies with the strong balance sheets that have come through this year the best. And those companies have to be aware of external events beyond their control that they have the financial power to withstand. And there will always be some. Yeah. So companies have to be more resilient, and in many cases that may mean that building up the balance sheet is preferable to actually increasing the level of dividends.
Thank you for that. And in terms of the medium-term consequences, how do you foresee this playing out, or the events of the last year playing out in the medium term with regards to the portfolios that we manage here at Fiducia?
Well, one of the things I think we have to be guarded for is the improvement in financial markets this year has come from a major re-rating of markets. Valuations have gone to very high levels. It's very hard to see how that re-rating can continue to increase, even if you have a good level of economic activity in the early part of next year. So you're much more dependent on those earnings coming through, those profits coming through. And that is what I think will power markets. It won't be about re-rating, but it will be about profits being paid out. And that probably means that the early start of the year will be good news for equities, but I don't think we will see the same level of leadership of the equity markets as we had in the last few months. Clearly, it's been very much the tech sectors, the Amazons of this world, and the Facebooks and the Zooms that have led the way. Whereas now I suspect that people are looking to the more cyclical areas of the financial markets, and places like Europe and certainly like the emerging markets in Asia, which to some degree have lagged behind the United States, as more likely to have the improvement in earnings which will allow their markets to outperform some of the tech-orientated markets that we've seen this year. And equally, I think small and mid-cap companies will probably do better than large cap. Again, that's normally what happens in the early stages of an economic recovery. So the leadership within financial markets will be different, and hence we have to weight our portfolios accordingly, moving away perhaps from some of the digital themes that have dominated to looking much more at the cyclical areas. And one area which I think we need to keep in mind, not just for this coming year, but arguably for a while after that, is what's happening to commodities. Because the zero carbon target by 2050, the Chinese and the Indians are pursuing solar and wind turbine power more aggressively than we in Europe, let alone the United States is. So green energy is very much the theme of the moment. And green energy is commodity intensive. To build up the new infrastructure will actually take a lot of commodities. So the commodity markets have begun to respond to that, and I suspect we'll see a lot more of that. And oil, which until recently has been in the doldrums, should actually respond to this environment and go back to the $50 to $70 a barrel range that we had before the pandemic struck. So right across the board, I'm looking for a good commodity response.
Okay. And you touched on infrastructure then, Michael. With the election of Biden and some of the promises for the Democrats, do you see, and obviously a lot of governments in Europe are looking to spend their way out of some of the problems we've got here, do you see an increase in infrastructure spend as part of this, aligned to the green spend as well?
Oh, very much so. And I think they're committing to that right across the board. And it's partly because of that, and partly because of its consequences for commodities, that one of the things I think we have to be wary of in the medium term is inflation rising again.
Yeah.
Now, some central banks have already eased back on their inflation targets and have said that even if inflation rises, we will allow it to go above our target for a length of time, just that it's been well below target in the last few years. So there is a more inflation risk in the economic scenario, and that obviously has to be reflected in the mix of assets we have between equities, bonds, and real assets, things like property and infrastructure.
Okay. One final question. In terms of currencies, I mean, we've touched in previous investment committee meetings about the potential structural decline of the dollar. There is talk about the euro being potentially overvalued given where it's at today, and obviously sterling has been impacted by Brexit. Do you see any big themes in 2020 with regards to currencies, the ones I've mentioned, or indeed any others?
Well, the dollar peaked out in about March of this year and has been declining steadily since then. Given the interest rates remaining low in the States for a while and the degree of deficits that they have, that I think that decline in the dollar has further to run. I think it will be to the benefit of emerging markets particularly, that weaker dollar will give something of a boost. Yeah. And so I think most of the currency appreciation would be in the emerging areas, not least in Asia, rather than in Europe. Although sterling is still cheap relative to the dollar, you know, it was a lot cheaper earlier this year when it was under 120. It's obviously bounced quite a way already, and probably it's now only about 6 or 7% cheap relative to the dollar. The bigger currency gains, I think, are elsewhere in the world, particularly in Asia.
Interesting. Well, thank you very much, Michael, for that whistle-stop tour. I believe we'll be having a catch-up in the new year with regards to potentially including clients as well. So I'd like to take this opportunity to wish you a Merry Christmas and a Happy New Year.
That's very kind. Thank you, Gordon.
Take care.